Welcome to Iron Financial. This is the place where we help you forge a stronger portfolio by cutting right through the market's noise and weakness. I'm your lead analyst, and today we are putting a company on the rack. We are going to stress test its very foundation. We are tearing down the latest post-earnings report for the RV giant Thor Industries. That's ticker THO. And folks, the numbers that just dropped are absolutely screaming for a closer look.
So, look, on the surface, the headline here is an absolute blockbuster. We're talking about an earnings beat of over 1,000%. Yeah, you heard that right. In a market like this, a number like that just screams buy, buy, buy. But you know, here at Iron Financial, we don't trade the headlines. We dig deeper. We look for the steel and the concrete underneath all that hype. So the central question we're going to hammer out today is this. Does this absolutely explosive number signal a company with a rock-solid, high-growth engine, or is it just a flashy new paint job hiding a cracked and rusting frame? All right, let's get to work and start forging the bull case.
Okay, first things first, let's build out the bull case. And I gotta be honest, the numbers give us some really heavy-duty materials to work with here. The initial data, it looks incredibly powerful. It suggests a company that's not just, navigating a tough consumer environment, but is actually accelerating right through it. The market was completely braced for weakness, and instead Thor delivered a massive show of force.
Now this is the number. This is the number that dropped jaws all over Wall Street. For its second quarter, Thor Industries reported earnings per share of 34 cents. Now, to really wrap your head around the sheer scale of this, you have to understand what the so-called experts were predicting. They were basically braced for a total and complete wipeout. The disconnect here is it's staggering. I mean, look at this. The analyst consensus was for a measly 3 cents per share. 3 cents. Thor didn't just beat that estimate, they demolished it, they pulverized it. This is a beat of over 1,000%. It's the kind of number that forces everyone to completely reevaluate a company's entire trajectory. It just screams that Wall Street fundamentally, completely misunderstood the operational strength in the demand picture heading into this quarter. They weren't just wrong, they were on another planet.
And this wasn't just some accounting trick on the bottom line either. No way. The top-line revenue number was also a huge, significant beat. Thor pulled in $2.13 billion, just sailing past the $1.96 billion that analysts had been penciling in. Now, this isn't just noise. That's a beat of over $170 million. In a market where we're told consumers are tightening their belts, especially on big-ticket discretionary items like RVs, well, this kind of revenue strength is an incredibly powerful signal that something is going very, very right over there.
And just look at the turnaround right here. I mean, in the same quarter last year, they posted a net loss of over $16 million. They were in the red. This year, a net income of $17.8 million. That massive swing from deep red ink to solid black is the absolute cornerstone of the bull argument. Gross profit is up. Net sales are up 5.3%. They've gone from literally bleeding money to printing it, at least on the income statement. This is exactly the kind of powerful momentum that gets investors really, really excited.
So the big question is, where did all this power come from? Well, this number right here is the key. A staggering 29.3% year-over-year sales growth in their North American Motorized segment. This isn't just growth, folks. It is an absolute explosion. What it tells us is that while one part of the market might be a little soft, Thor has found a high-octane growth engine in its motorized RVs. And right now, it is firing on all cylinders. This one segment is doing all the heavy lifting for the entire company. And to cap it all off, you have the CEO, Bob Martin, who is essentially taking a victory lap. He's not sounding cautious, he's not hedging his bets, he's talking about momentum, he's talking about confidence, he's pointing to a clearly defined strategy. So the bull case is crystal clear. A massive, jaw-dropping earnings beat, strong top-line revenue, a powerhouse growth segment doing all the work, and a supremely confident management team leading the charge. From this angle, the company's foundation looks like it's forged from solid steel. But not everyone is convinced. Our market skeptic sees some pretty serious issues just beneath the surface. That's right, hold on a second. 1,000% beat is impressive, I'll give you that. But headlines can be incredibly deceiving. My job here is to take a sledgehammer to these numbers and see what actually holds up under pressure. Because when a story looks this good, this perfect, you have to ask yourself, what are they not showing you? It's time to get out the magnifying glass and inspect this foundation for cracks. And trust me, they are there, and they run deep. Let's start right here. Gross margin. For any manufacturing company, this is the absolute bedrock of profitability. And Thor's is shrinking. It fell from 12.1% down to 11.8%. Now that might seem small, it's just 30 basis points, but believe me, it is a huge red flag.
It tells you that for every single dollar of those impressive sales they're bringing in, they are actually keeping less profit. So that growth we were just celebrating, it's becoming less profitable? Are they slashing prices to move product? Are their costs spiraling out of control? Either way you slice it, this is the very first crack in the armor. And here is the biggest problem. That North American Motorized segment might be a high-torque engine, sure, but this segment, the North American Towables, this is supposed to be the chassis of the whole vehicle. It's their largest, most foundational business, and it is in an absolute free fall. Net sales plummeted by 14.2%, and even worse, look at the unit shipments. They plunged an alarming 23%. You simply cannot claim the entire structure is sound when your biggest, most important support beam is actively rotting away.
And don't just take my word for it. This wasn't some kind of planned, managed decline. It was a massive miss against what Wall Street was already expecting. Analysts were bracing for over 24,000 unit shipments. Thor couldn't even deliver 22,000. They were expecting $774 million in sales from this segment. Thor came in way short at $710 million. So the bull case celebrates this big beat in one area while conveniently and completely ignoring a catastrophic miss in their core business. This isn't a strategic pivot, it's a massive problem.
Now let's just look across the pond to Europe for a minute. The bulls, they'll tell you that sales grew over there. And okay, technically they did. But let's really look at the quality of that growth. Their gross margin in Europe fell by 220 basis points. And why? Well, it's a nasty double whammy. The vast majority of that pressure, 70% of it, came from selling a higher mix of cheaper, lower margin products. And on top of that, their warranty costs are going up. So let me get this straight. They're selling cheaper stuff that's also costing them more money after the sale. That is not a sustainable model for growth, period.
And when we look forward, the risks are just piling up. They're undergoing a sweeping restructuring, which introduces massive execution risk. Things could go very wrong. They're already booking millions in restructuring costs. But here it is, the most damning piece of evidence, is their own guidance. For the full year, they are guiding the market below what analysts were already expecting. Now, if management was so confident, so thrilled about their momentum, why on earth is they telling the market to expect less than the consensus? It doesn't add up. And to top it all off, insiders have been selling shares. When the people who know the company best are reducing their positions, that's a signal you simply cannot ignore. Back to you, analyst. What does the core structure really look like?
All right, so we have a very clear conflict. We've got a powerful growth engine in one segment, absolutely, but we also have evidence of serious structural decay in others. To settle this, we have to go deeper. A company's true strength isn't just its income statement, it's the balance sheet and, crucially, the cash flow. So it is time to stress test the core financial foundation of this company and see if it can actually handle the pressure. Okay, so let's look at the balance sheet from back in October. At first glance, you do see some apparent strengths. Their current assets are significantly larger than their current liabilities, which is a very positive sign for short-term financial health. The long-term debt seems pretty manageable relative to their equity, but the skeptic is absolutely right to point out a potential yellow flag. Just look at inventories. They jumped from $1.35 billion at the end of July to over $1.46 billion at the end of October. That's a big move.
And this slide really puts it all into perspective. From a purely structural standpoint, a current ratio of 1.81 is strong. A debt-to-equity ratio of 0.21 is very conservative. On paper, this company is not over-leveraged. But that 8.3% quarterly jump in inventory, that is the crucial point of debate. As the analyst, I can see a company building up inventory for the big spring selling season, which makes sense. But the skeptic sees a potential problem. That is a lot of capital tied up in product that absolutely needs to be sold. If consumer demand falters even a little bit, that inventory becomes a massive liability, forcing huge discounts that will absolutely crush those already thinning margins. So the question becomes, is this smart preparation or a potential glut? Skeptic, there's one more document that I think might just settle this whole thing.
And this is where the whole story takes a very dark turn. The income statement can be dressed up with accounting. The balance sheet, well, it's just a snapshot in time. But the statement of cash flows, that tells the unvarnished truth. It shows you where the actual, real cash is going. It is the ultimate lie detector in finance. And just look at the very first line item, net cash provided by or used in operating activities. See that number in parentheses? That means cash is flowing out. This is the ultimate red flag.
So here is the crucial, critical point. Over the entire first half of their fiscal year, despite posting a net income on paper, this company's core operations burned through $157.1 million in cold, hard cash. Let me repeat that because it is vital. They are not generating cash from their day-to-day business of building and selling RVs.
They are burning it. Remember this, profit is an opinion, but cash is a fact. And the fact is, the operational heart of this company is hemorrhaging cash. This isn't just a small crack in the foundation. This is a sinkhole opening up right underneath the entire structure. So, analyst, what's the final call?
Okay, we've seen the bull case, built on a spectacular headline earnings beat. We've taken the skeptic's hammer to the foundation and found some very significant weaknesses. So now it is time to put it all together. It's time to weigh all the evidence and deliver the final iron financial verdict. Is this an opportunity to build a position, or is this a structure that you need to avoid at all costs?
So here it is, the final showdown. On one side, you have that massive beat, the undeniable strength in the motorized segment, and what looks like a solid balance sheet. But on the other side, you have eroding profitability, a core business that's collapsing, rising inventory levels, cautious guidance from management themselves, and the single most damning fact: they are burning through operating cash. The bull case is the story they want you to believe. The bear case, well, that's the reality the numbers are telling us.
Our verdict is this: Thor Industries is a high-torque engine bolted to a cracking frame. It's that simple. They have a powerful, impressive growth engine in their motorized division that is fully capable of producing these incredible headline numbers. But that powerful engine is attached to a chassis, the core Towables business, and the underlying cash flow that is showing clear signs of catastrophic structural failure. You can rev that engine all you want, but if the frame it's on completely falls apart, the whole thing is going to end up in a ditch. Our skeptic will hammer home the key risks you need to watch.
Okay, let's hammer home these final takeaways so there's no confusion. First, do not be seduced by that headline beat. It is a smokescreen, and it is masking deep, serious operational issues. Second, this pivot to motorized RVs is real, but is not nearly enough to offset the decay in their much larger core business. It's a band-aid on a gaping wound. Third, and this is the most critical point, negative operating cash flow is a 5-alarm fire. A company that does not generate cash from its primary business has a fundamental existential problem. And finally, with a major restructuring underway, the risk that management simply can't pull this off is substantial.
We're going to leave you with this one final thought. The clock is ticking on this company. Thor's management is making a very bold bet. They're trying to shift the company's weight onto a new growth engine, while simultaneously trying to patch up the crumbling foundation of its old one. The ultimate question for any investor looking at this stock is this: can they actually rebuild that foundation and, more importantly, fix the cash burn before the next economic headwind hits? Or will the sheer weight of that powerful new engine be the very thing that causes the entire cracking frame to finally collapse? That is the risk you are taking with this stock right now. Thanks for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.